Welcome back to our series on important financial ratios in business. In our previous video, we talked about gross profit margin and how it measures a company's profitability from its sales. Today, we're going to dive deeper and discuss another key ratio, operating profit margin. Operating profit margin is a powerful tool that helps businesses and investors evaluate a company's profitability from its operations after accounting for operating expenses. By understanding and tracking this ratio, companies can gain insight into their operational efficiency and make informed decisions about how to improve their financial performance. In this video, we'll explore the meaning of operating profit margin, its importance, how to calculate it, and how it differs from gross profit margin. We'll also look at real-world examples of companies with high and low operating profit margins and discuss how changes in this ratio can signal changes in a company's financial health. Operating profit margin is a financial ratio that measures a company's profitability from its operations after accounting for all operating expenses. This includes the cost of goods sold, salaries, rent, utilities, and marketing expenses. This ratio is different from gross profit margin, which only takes into account the cost of goods sold. By including all operating expenses, operating profit margin gives a more accurate picture of a company's profitability. A high operating profit margin is a positive sign for investors, as it indicates that the company is generating a significant amount of profit from its core business activities. Conversely, a low operating profit margin may suggest that a company is struggling to generate profits from its core business. Operating profit margin is an important metric for investors and analysts, as it helps to assess a company's financial health and performance. The operating profit margin shows how much profit a company generates from its operations, and a higher operating profit margin indicates that the company is more efficient at generating profits from its operations and has better control over its costs. On the other hand, a low operating profit margin could be a warning sign for investors, indicating that the company may be struggling to generate profits or may have excessive operating expenses. Operating profit margin is an important metric for companies and investors to track because it provides insight into a company's financial health and performance. By measuring a company's profitability from its core business operations after accounting for operating expenses, operating profit margin helps to identify the company's ability to generate profits from its primary activities. A high operating profit margin indicates that the company is efficiently managing its operating expenses while generating strong revenue from its primary activities. This is a positive signal for investors as it suggests that the company is generating significant profits from its core business operations, which could lead to long-term growth and a higher stock price. On the other hand, a low operating profit margin may indicate that the company is struggling to control its operating expenses or generate sufficient revenue from its primary activities. This could be a warning sign for investors as it suggests that the company may face challenges in the future if it cannot improve its operating efficiency or increase its revenue streams. In addition, tracking changes in a company's operating profit margin over time can help investors to identify trends and patterns that may signal changes in the company's financial performance. For example, if a company's operating profit margin has been declining over multiple quarters or years, it may indicate that the company is facing increasing operating expenses or competitive pressures that could impact its long-term profitability. Calculating operating profit margin is straightforward. It is calculated by dividing operating profit by total revenue. Operating profit. This is the profit a company generates from its core business activities, after deducting all of its operating expenses. It does not include any interest expenses or taxes paid by the company. Operating profit is calculated by subtracting operating expenses from the company's revenue. Total revenue. This is the total amount of money a company generates from all of its sales and business activities. It includes revenue from the sale of goods or services, as well as any other sources of income. Let's calculate Apple's operating profit margin for 2021. The company's revenue and operating profit data were taken from the company's 2021 income statement. In 2021, Apple's revenue was $297.4 billion, and operating profit was $108.9 billion. So in 2021, Apple's operating profit margin was 0.366. This indicator is quite good for such a large company, but to better understand how efficient Apple is, let's also calculate the operating profit margin of Apple's main competitor, Samsung, for 2021. The company's revenue and operating profit data were taken from the company's 2021 income statement. In 2021, Samsung's revenue was $244.4 billion, and operating profit was $45.1 billion. In 2021, Samsung's operating profit margin was 0.185. Thus, comparing the operating profit margin of these two companies for 2021, we can say that Apple is more efficient. However, it would be wrong to make such a conclusion based on only 1 year of data for one indicator. To draw such a conclusion, it is necessary to calculate a set of financial ratios for a long period of time and then study it. Only then will it be possible to draw the correct conclusion. As a result, business managers frequently employ tools that enable interactive analysis of financial ratios. ControlZenith Consulting offers such interactive dashboards. The interactive dashboards we offer are created in Excel, which allows even those without deep professional knowledge to use them. To order interactive dashboards, click on the link in the description. However, if you have calculated the gross profit margin for several years, how can we analyze it and what information can it give us? Operating profit margin dynamics can take three forms: increasing, decreasing, and stable. Apple is one of the companies whose operating profit margin has increased in recent years. A company's operating profit margin can increase due to several factors. One of the primary reasons is an increase in revenue. If a company can increase its sales without a corresponding increase in expenses, its operating profit margin will increase. This could be achieved through increased market share, launching new products or services, or expanding into new geographic regions. Another reason for an increase in operating profit margin could be a decrease in operating expenses. Companies can achieve this by optimizing their processes, reducing waste, cutting down on unnecessary expenses, or renegotiating contracts with suppliers. In some cases, a company may also reduce its workforce or shut down unprofitable business units to cut costs. Lastly, a company's operating profit margin can increase due to a change in its product mix. If a company shifts its focus to selling higher margin products or services, its operating profit margin will increase. This could be achieved through product innovation, marketing campaigns, or acquiring new businesses with more profitable products or services. XYZ is one of those companies whose operating profit margin has decreased in recent years. There are several reasons why a company's operating profit margin may decrease. Increase in operating expenses. If a company's operating expenses, such as salaries, rent, utilities, and marketing expenses, increase while its revenue remains the same, its operating profit margin will decrease. This could be due to a variety of reasons, such as an increase in the cost of raw materials or labor, or higher marketing expenses to promote a new product or service. Decrease in revenue. If a company's revenue decreases while its operating expenses remain the same or increase, its operating profit margin will decrease. This could be due to a variety of factors, such as increased competition, economic downturns, or a decline in consumer demand for the company's products or services. Decrease in gross profit margin. If a company's gross profit margin decreases, which could be due to an increase in the cost of goods sold or a decrease in the selling price of the company's products or services, its operating profit margin will also decrease since the operating expenses remain constant. If you're interested in learning more about how to analyze gross profit margin, check out our previous YouTube video. Inefficient operations. If a company is not managing its operations efficiently, it may experience a decrease in its operating profit margin. This could be due to various factors, such as poor inventory management, inefficient supply chain management, or overstaffing. Coca-Cola is one of those companies whose operating profit margin has remained stable in recent years. A company's operating profit margin can stay stable for a number of reasons. Firstly, the company may have a stable revenue stream and cost structure, which allows them to maintain consistent profitability over time. This could be due to having long-term contracts with clients, or operating in a stable industry with relatively predictable demand and costs. Secondly, the company may be actively managing their costs and revenues in order to maintain a stable profit margin. This could involve regularly reviewing and adjusting their pricing, cost structure, or product mix to ensure that their profitability remains consistent. Lastly, a stable operating profit margin could be a result of the company investing in growth initiatives, which may initially impact their profitability but ultimately lead to increased revenue and profits in the long run. In this case, the stable operating profit margin may be a sign that the company is successfully balancing short-term profitability with long-term growth. Anyway, analyzing only one financial ratio and making decisions based on it can be wrong. And calculating many financial ratios at once, comparing them with different timeframes will take a lot of time. The solution to this can be interactive dashboards, which will allow you to analyze several financial ratios at any time, as well as study the dynamics of financial indicators for the same period. ControlZenith Consulting offers interactive dashboards with interactive reports, predictive analytics and financial models. Using our services, you can get everything you need to assess the status of the company and effective management. We can help you create any type of dashboard in your desired format, such as financial status, company development, cash flow, employee performance, project status, investment, sales, and other dashboards. Reports can be in any format and structure you like. They can include the group of data and you can choose the period from your dashboard. Forecasting models will enable you to forecast your revenues, expenses, profits, etc., which can help you set targets and make the right decisions. Analysis and modeling of corporate finance will provide an opportunity to find out the factors affecting sales volume, prices, and other indicators of the company. Subscribe to our YouTube channel, and like or dislike the video so we can understand whether you liked it or not. Also, leave a comment on which financial ratio we should make a video about next time. And in the next video, someone who left a comment and subscribed to our YouTube channel will be chosen at random and will be given 50% off the interactive dashboards we offer. ControlZenith Consulting, your efficiency guarantor.